Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, welcome everyone to this month's edition of the AWA Market Minute. Scott, how are you?
Doing well, yeah. Happy St. Patrick's Day.
It is, and I was gonna place a bet that you really didn't even know today was St. Patrick's Day. I already lost that bet.
Well, my elementary kids greeted me with a St. Patrick's Day greeting, so yeah, I wouldn't have remembered otherwise.
I actually did not remember. I'm not wearing any green, which is probably because I am an adult, but just kidding if I've offended anyone. I know some people really get into the holiday. We're excited to be here with you guys today, and thanks for spending some time with us. This is a topic that we want to cover today that a lot of people are very eager and frankly anxious about, and rightfully so, Scott. The past few weeks have been dominated by geopolitical headlines. We've seen war break out with Iran. Energy prices have spiked. Markets are reacting across the board. So I thought today we kind of go through, that topic, markets and the Iranian conflict, and then what we can learn from what's happening and how we can respond to it. Scott, let's dive in with, since this beginning of the conflict, I'm going to share a slide here. Walk us through what have markets done over this short little stretch.
Yeah, Paul, it's been super interesting to kind of see what's happened here. There's an adage that sometimes we have weeks where decades happen, and that's kind of what this feels like. A very historic time and much to be seen as far as kind of how this conflict unfolds. But as far as the market response, there's been few bright spots. Unfortunately, one of those bright spots is a notable exception, and that's commodities. And that's no surprise, right? With the Strait of Hormuz being closed and energy markets disrupted, and all of the energy derivatives that come from oil, no surprise that commodities are up pretty significantly. In terms of what's down, this is maybe what's a little bit surprising. One would expect equities to be down during this time, and indeed they are. The S&P is down about 2.5%. What's maybe not as expected is, one, how hard hit international's been hit. It's down about 7%. So a bit of a gap between international and U.S. U.S. has been perceived as a little bit more of a flight to safety, although it's down significantly.
And history says that's probably to be expected, correct?
Yeah, I think so. I think maybe the magnitude with this one's a little bit different because there's, a 4+ percentage point delta there in a relatively short time. So that's maybe a little bit surprising. But the most surprising has been what's happened with both bonds and gold. These are traditionally safe haven assets. Just high quality bonds down about 2%. If you look at kind of what longer dated bonds are, those are down almost 4%. And then gold, surprisingly, is down about 5%. And so a little bit unusual to say, hey, during a time of conflict when people typically sell stocks and buy safe haven assets, those safe haven assets haven't necessarily kind of filled that safe haven status.
Yeah, and I think there's some there's a thesis here as to kind of what's driving some of that, and I think we want to get into that. Before we dive into the kind of that bond specific conversation, let's talk about commodities and why we're seeing that significant surge. Here we've got kind of the Strait of Hormuz. Scott, talk to us about kind of the oil and gas transport passage and what's going on here right now.
Yeah, so I'm sure everyone's kind of been following this, but the Strait of Hormuz is kind of the global choke point for a lot of energy flows. So a large quantity of oil from the major oil producing countries flows through this narrow gap called the Strait of Hormuz. It's about, I think, 21 miles at its narrowest point. And so what that does is it congests traffic there, but it also is a very dangerous spot for vessels to pass through because it is so tight. And the Iranians have effectively closed that down. And by extension, there's very little that's going through. And most people are familiar, Paul, with energy and natural gas, the LNG that flows through there, and the oil that flows through there. In addition, there's just a lot of commodities generally. I think I read something that said 24% of the world's aluminum passes through there. And so it's not limited to that. And the countries that are really getting acutely impacted are a lot of the countries in Asia. A lot of Asia's energy in particular flows through there. You look at oil prices in Singapore markets and commodities in Singapore, which is kind of the global hub for commodities in Asia, and those prices have really been elevated. I've seen things like diesel fuel and jet fuel almost, coming close to doubling in price in a relatively short amount of time. So it is a critical kind of passageway, and unfortunately, it has slowed to a standstill.
Yeah, and I mean, the major exporters that rely on that would be like Saudi Arabia, Iraq, Kuwait, Qatar. I think UEA, others are using that. And so it's essentially the world's most important kind of energy checkpoint, right? I mean, and I think what I read, Scott, was about a quarter of global oil flows through that narrow passage. It's 20 million barrels a day. And so, when you get that checkpoint kind of tightened or shut off or at very least disruption, we see a significant disruption in the overall global supply chain. I mean, and then the other issues that arise from this would be like insurance costs for tankers spike during that kind of conflict. Energy traders will price in that risk of restricted shipping lanes. I mean, we're seeing, I think I read this morning, just a ton of naval activity trying to get into there. And internationally, the U.S. is calling on allies to say, come help us try to police this thing so we can open up, the Strait of Hormuz. And I think what is the net effect, Scott? Oil went from roughly $67 to what is it at today?
It's close to 100. It's kind of where it's been hovering. So yeah, pretty significant jump. It's not unprecedented. In 2008, during the financial crisis, right up to that, oil went well north of that. And when we had Gulf War I, oil went through the roof. And so it's not unprecedented or unusual for it to happen, but it certainly popped in the last couple of weeks.
Yeah. Well, one interesting element here, to your earlier point, Scott, is the bond market hasn't behaved the way people might expect during a conflict. Typically, during wars, we see a flight to safety into bonds. So maybe talk to us a little bit about what has happened this time around.
Yeah, no, it's a great thing, I think, to dive into, because I think to understand this, we have to look what happened before the February 28th attacks started. And prior to that, we had started to get some inflation data, Paul, that was pretty rough. So the chart we're looking at, or the chart that I'd say we have a look at here, is the producer price index. And so this shows kind of the cost of inputs for manufacturers and others who kind of put together finished goods. And that most recent print came in at about 0.5% month over month. When we annualize that figure, that's like a 6% figure. And so this surprised a lot of market participants that, hey, inflation is higher than maybe what we'd expected. And when inflation is high, the extension of that is we're probably not going to get as much interest rate relief. And so going into the conflict saying, hey, inflation's already appearing to be higher than what the Fed would like, and then having a big inflation shock right on the top of it, it makes it really hard to say, hey, the Fed's going to be pretty, fast and loose with rate cuts against that kind of backdrop. And so I think what we're seeing with the bond market specifically is the fear about the lack of rate cuts is greater than the kind of fear, if you will, about the economic impacts of a prolonged crisis. And that's why we're seeing bonds kind of behave adversely.
And so the timing of this is really interesting, right? I mean, just to kind of go back to like basic economics 101, the Fed uses their economic policy to control what the inflation impact might be on the economy. And so they have to raise rates in order to tamp down inflation, or at least what appears to be the hot inflation, kind of ticking up those embers of inflation. We had hoped maybe would have been snuffed out a little bit, and according to the latest data, maybe not totally snuffed out. And so the timing of this conflict, where we would typically see bonds kind of say, hey, there's a safe asset class here. All of a sudden, it's like, okay, maybe it's not as safe as asset class as we'd hoped. So, I think what's interesting, Scott. So this next chart here actually shows kind of that data that we use to determine the Fed expectations for rates, and we're not really pricing in a rate drop anymore until clear towards the back half, if not the very end of this year. Is that right?
Yeah, that's exactly right, Paul. And the Fed is meeting this week, actually. They're meeting today, and they'll kind of conclude their meeting tomorrow. And it'll be interesting to read their notes and comments. A lot of market participants are watching that closely. But going from a scenario where we were potentially looking at multiple rate cuts this year to a scenario where we're maybe going to get one in the back half of the year, that's a pretty dramatic change as far as interest rate expectations. And the concern here is, again, that if inflation's elevated, we can't have interest rates too low, because that will further, kind of foster the inflationary cycle. And it'll be interesting to see what the comments are tomorrow, because there is some kind of speculation that they might say, hey, we're actually going to pause on rate cuts, and there might not be any rate cuts at all this year. So it'll be interesting to see what that verbiage is.
Yeah, so the environment kind of increases the likelihood that maybe we end up with a higher for longer interest rate scenario, which no one's looking forward to. So,
yep.
Let's talk a little bit about, Scott, about the kind of some of the strange behavior of gold. You talked about how gold has reacted specifically during this conflict, and I think it's something that is also unique, kind of similar to what we're seeing with bonds. It surprised many investors that gold actually kind of started falling during the start of the conflict. We saw, at least early on, a drop, initial more than 2% kind of drop since the beginning of the conflict, where that would have been perceived as a more traditional safe haven asset. So talk to us about kind of what your thesis is as to why we're seeing that happen.
Yeah, this one's not quite as intuitive as the bond one. The bond we can easily explain with inflation expectations. The gold one's a little bit more nuanced, because when we do have periods of war, often gold is a flight to safety asset. And I think what's happened, Paul, is with gold's dramatic rise over the past few years, I think that's perceived as less and less of a safe haven asset. When you have an asset class that's appreciated as much as gold, people question, hey, how much more upside is there truly available here? And so I think the fact that it's been a hot trade for an extended period of time has maybe eroded some of that safe haven status that we traditionally see.
So yeah, so at the current price levels, kind of what your thesis is, maybe investors aren't viewing gold as a safe asset, but maybe the pricing has been so hot for the last several years that it's actually priced in a little bit more risk than it is defensive. And I think that's that kind of highlights or underscores the point you'd made. If we look at the same kind of chart on gold values during the Russia-Ukraine conflict beginning, we can see a very different story than what we're seeing today.
Yeah, so for kicks, we pulled this chart, and it shows during the kind of same number of days into the conflict with Russia and Ukraine, how did gold and stocks perform? And you can see stocks were down about 5%. Gold was up about 5%. And this is more traditional behavior. This is more kind of expected behavior as far as that goes. And in the long term, I don't think it diminishes gold's stature as a safe haven asset. But I do think that we have a bit of a unique circumstance here where everyone, from individual investors to central banks, you name it, everyone has been buying gold en masse. And I think as a result of that, there's probably just, a perception that there's maybe not as much safety or upside in it at this particular point in time.
So it's possible that gold's, roughly 180% increase. The run that we've seen over the last several years has maybe changed the way investors think about it. And maybe we've got a lot of the early pricing already built into it, and we'll see if it turns into a safe asset in the future again. So, Scott, when events like this unfold, investors start naturally asking questions about, okay, well, what's going to happen next? When analyzing geopolitical events, in your latest CIO insights, you talked about thinking about kind of a couple of different potential outcomes and scenarios. Maybe give us some high level kind of what are some different outcomes or scenarios that you see potentially playing out here?
Yeah, so more often than not, when we do have a big geopolitical conflict or a event of this nature, it's often a fairly quick recovery. I call these like tennis ball. Well, I'll pay homage to you, Paul. It's a pickleball type bounce,
There you
right?
go.
Like the ball hits the ground and it immediately bounces back up. And a lot of times markets will kind of do that, right? And that's the typical behavior. There are some notable exceptions. When we had like the Yom Kippur War and the consequent the oil embargoes and everything on the back of that, that was a longer downturn for markets. And so the $100,000 question today is this like most conflicts where it's just a sharp drop and a sharp snap back, which is kind of the most likely outcome? Or is there potential for this to be longer in the tooth and more like the Yom Kippur War, where because of energy and commodity impacts, this ends up being a longer duration event?
Yeah, and in your market insights, you talked about a couple different potential scenarios with this actual conflict. One scenario was, the energy corridors reopen quickly, markets normalize. What does that look like?
Yeah, so in terms of there's a variety of potential outcomes, but either by like an end to the conflict where there's a negotiated peace, or by virtue of destroying Iranian capability to kind of close down the strait, or armed escorts kind of leading ships through. That's probably what a conclusion looks like. And some of those are longer in the tooth. Markets are wondering who's going to blink first in this particular conflict. The Iranian strategy appears to be inflict as much economic pain with the hope that kind of drives popular support of the conflict down, and the U.S. kind of withdraws, giving the Iranians a victory by virtue of the survival of the regime, and then using the Strait of Hormuz as a lever to exact what they want. So that's what I worry about as far as that goes.
Yeah, and I mean that would kind of lead us into that prolonged conflict, sustained energy shocks, slower growth, and I guess the worst possible outcome that we can envision would be a broader geopolitical escalation. And obviously, in your notes, in your article you wrote, you talk about how that's probably unlikely. But obviously, what would markets kind of think about that in this situation?
Yeah, so that to your point, Paul, that's a worst case scenario, and there is some geopolitical chess that is happening right now. There's no question. You look at kind of the recent, tariff activity and kind of the strategic positioning as far as that goes. And then you look at, China with the monopoly on rare earths and using that as kind of a threat, toward the U.S. And I think, part of the U.S. response is, hey, with the Venezuelan government overthrow and with the stuff that's happening in Iran, between the two of those suppliers, that's, I think, 18% of Chinese oil. And so I think there's a broader geopolitical aspect that goes beyond Iran with this particular conflict. That being said, I think the likelihood of this spilling over and being a broader conflict is relatively minor. But to answer your question, it would be catastrophic, right? If we, had a conflict with, China or another kind of near peer adversary over this type of thing. Anything we're seeing right now would be exacerbated many, many times over. You'd see greater drops in equity prices. You'd see commodity prices at a more elevated level. And something like that, by definition, is going to be lengthier in duration. And the longer these conflicts go and the longer that supply chains are impacted, the harder or the more intense the economic fallout is on the back of it. And that's why the duration of this particular shutdown is so important in kind of the long-term calculus.
Yeah, I think it's it's really good conversation because we get these questions all the time. I mean, today's conflict is always front and center, top of mind. And it, it's kind of one of those things where it's the only thing you can think and see and feel, especially when you're in retirement and you're an investor. And whenever geopolitical events like this occur, investors will always assume that this is it. Markets are going to collapse. And there's kind of an emotional response to how to react to this kind of thing. History, however, does tell a more nuanced story. Historically, how have markets fared during major conflicts?
Yeah, so during major conflicts, markets have done pretty well. You can look at number one right there, a Cuban Missile Crisis, right? One could argue that's about as intense a short duration item. I mean, the two superpowers were on the brink of nuclear war, and 1 month after that, markets were up 5.1%. 3 months after, it was up 14.1%. So this speaks to the rapid, drop and then rapid rise. If you look at with the Iraq War in 2003, markets were up 1 month after the fact, and then 3 months after the fact, they were up as well. The notable exceptions are associated with some of those Middle Eastern conflicts that impacted energy. So like the Yom Kippur War, in addition to the oil embargo on the back of it. With that, markets were down, 3.9% after the start of the kind of conflict. And then 3 months later, they were still down about 10.7%. And then over a 12-month period of time, they were down significantly. And this particular scenario, Paul, I think is the one that has people most anxious, saying, hey, is there a potential scenario where this is a replica of that, where we have a commodity-driven market pullback with high inflation, recession on the back end? I think that's people's biggest concern. And there is maybe a lighter version of that. If you look at kind of what happened after Gulf War I, on the back of Gulf War I, what happened is there was a mild recession on the back of it that contributed to Bush 1 not being reelected. It was in the middle of a recession, but that's maybe a better historical analog. I think the 73 one was probably, an extreme example. Right now, we have far greater energy independence today.
That's what I was going to ask you is how today's U.S. energy position is different than in the 70s.
Yeah, in the 70s, we had such a huge reliance on oil from the Middle East that they really had us in a conundrum as far as that goes. But where we have greater energy independence today, the impact is likely far less. That's not to minimize it. I mean, if we have a prolonged impact to global energy markets, it's enough of a hit where we could see it push over into recession. And if we have high inflation in association with that, that's an ugly outcome. But even under an extreme scenario, it's probably not going to be as severe as what happened in 1973.
So I think it's safe to say that, markets generally recover faster than we as investors might expect, but we obviously need to be mindful of potential outcomes here. There have been periods of geopolitical events that have caused significant damage to the stock market, and albeit those seem to be the exception, that is a potential outcome that we need to be mindful of. And so let's maybe talk a little bit about not being, I guess, one, the emotional reaction during this geopolitical crisis. So let's kind of maybe try to bring that into some practical advice. When geopolitical shocks occur, what are some really common mistakes that investors make?
Yeah, so one that we'll hear is, go to cash, right? Pull everything out of the market and be conservative and kind of sit on the sidelines. And then when the dust is cleared, go back in. And conceptually, like it's not a bad concept, right? To say, hey, the conflict's hit, let's not expose ourselves to the conflict, and then when it's over, let's come back. The fallacy with that, Paul, is, as we both know, is the missing out on just a few of the great days as far as market goes really leaves a ton of money on the table over time.
Yeah, so this is a chart that goes back from 1988 through about 2 years ago, a year and a half back. And this talks about staying invested. This is going through the S&P 500 index, and hypothetical growth of a $10,000 investment during that period of time, if we'd stayed invested the entire time, the valuation versus taking the 5 best trading days out, I mean, we're talking about a 37% decrease to eliminate the 5 best trading days. Take out the 10 best trading days, you're down half. Take out the 30 best trading days, you're down 80+%. And if you eliminate the 50 best trading days, you're down 92% of the value. So if you've been invested that entire time, sans 50 trading days, you'd go from $500,000 invested to less than $40,000 earned, or total value. So I think this kind of underscores the point of why it's so important to stay invested during turbulent market periods. And then just to kind of further that point, here we have kind of a different take on it. This one goes back from 1997 to 2021, but staying fully invested on $100,000, generates about a 12% rate of return. If we miss the 10 best trading days, we're about 8% rate of return. If you miss the 20 best trading days, you're about a 5% rate of return, so on and so forth, to all the way where if we take out the 60 best days, you're actually down 3% over that period of time. And you made a point a minute ago, Scott. You said something like, the idea of us being able to say, hey, step aside during some of these conflicts, get back in when things look good again. You miss the downside, you pick up the upside. It seems brilliant. Unfortunately, the reality is that these quote unquote best trading days that take place in the market are all crowded right around the worst trading days. I mean, if we go back during the same period of time to 1997, the 30 best trading days, look at this. The tech wreck accounts for 20%. The financial crisis accounts for 40%. COVID, 20%. The other 20%. So the best trading days are all crowded right around the periods of time where things are really turbulent.
Yeah.
So what's some practical steps investors can consider during these volatile periods?
Yeah, and maybe just to underscore that once again, because I think this is just unbelievable data, and I think for all investors, this is super helpful because, again, intuitively, we hear it from folks that we sit down with where, hey, can we not just get out when the things are bad and get back in when things are good? This is the reason why, because we don't know when those 60 best days are going to occur, and the only way we ensure that we're kind of participating in those is by remaining invested. So, but there are some strategies we can have to maybe mitigate the stress a little bit. If you're finding that you're particularly stressed by market downturn, and as you watch your portfolio's values maybe drop a little bit when that occurs, one strategy is called letting the air out of the tires. And what we mean by that is reducing a little bit of your exposure, and that might give you a little bit of peace of mind. If you have, for example, 60% of your portfolio in stocks and the volatility is making you pretty anxious and you really need to feel like you're doing something to address that, maybe you trim that to 55% of your portfolio in stocks, and you've taken a little bit of risk off the table, you've set some money aside, and just that simple act of letting a little bit of air out of the tires can help you ride out the storm, because the ideal behavior in most instances is not doing anything. But if that's not going to kind of suit your kind of behavioral needs as far as that goes, letting a little bit of air out of the tires is helpful. The other thing I would say is it's very seldom a bad time to fix a flawed portfolio. And so if you uncover some pretty deep flaws in your portfolio when you have a downturn, it's seldom a bad time to make some corrections there. You want to be cognizant of things like capital gains and other things, and you want to make sure that you're not doing it necessarily during time of extreme duress like an 08. And each of those situations is kind of individualized, but it's seldom a bad time if your portfolio is fundamentally flawed to make some adjustments.
I love that. Some of the things that I think about when clients call nervous about this kind of thing, Roth conversions during downturns. I mean, that's just such an awesome opportunity. I mean, to say I've got $1 million IRA account, maybe I'm down 20%, so it's valued at $800,000. It's oftentimes, as we reviewed historically, it can be a very short-term conflict. So to then say, I'll take some of that money and do a Roth conversion on that money. And when we see the pricing kind of correct and stabilize, I've been able to convert the same underlying holding value with a 20% discount. So when markets recoup, I didn't have to deal with some of the tax implications that I would have had to do a Roth conversion during a good market. And so there's some really good opportunity there. I think the other one would be like tax loss harvesting. If I have after-tax money or non-qualified money, I love the idea of being able to say, can we go through and find assets that are down in value, but we like the asset, sell that asset for a tax benefit, buy it back, or maybe a proxy version of that asset for 30 days, then buy back the original asset. And now we've been able to bank some of these tax credits to be able to be applied to future gains in our portfolio. This is the kind of thing that I do personally with my own portfolio regularly. We do it with our clients' portfolios regularly. It's a very helpful tool to kind of offset those future gains. Scott, what do you think about something as easy as reducing media noise?
Yeah, I think that's huge. We live in a time where we're surrounded by news constantly, and most of said news has an agenda one way or the other, and it's a little difficult to find super objective news. We have to, in our job, look at a variety of sources and kind of triangulate where the truth actually lies. And we do this professionally, but if you're not doing this professionally, you probably don't need a lot of that noise in your life. And so it doesn't hurt sometimes to unplug, to not monitor it too closely, and to know that you have professionals kind of keeping an eye on it. But just that act can make it not seem as intense. There's an adage that we the things that give us the most kind of frustration and stress is when we worry about things that we cannot control. None of us can control when the Strait of Hormuz opens back up. None of us can control when this war comes to a conclusion. And fixating on that exclusively can be a really anxiety driving kind of exercise. And so we'd encourage you to yes, be aware of what's going on, but maybe not fixate on it too much, because I don't know how healthy that is.
I love that. And just maybe underscoring the importance of smart investing, our dynamic distribution concept of having multiple buckets in our portfolio, because we can't afford to postpone, enjoying retirement either. We can't afford to say, hey, I can't take that trip to Hawaii this year because markets are acting the way they are. I've got this Iranian conflict. I have to keep my money where it is. And the answer is, well, by having a bucketed approach, we actually have certain parts of your portfolio that are ready and able to be spent. And it's a very valuable thing. This is lastly, just a chart of the Dow Jones growth chart going clear back, almost 20 years till today. And Scott, if you had to summarize kind of the big lesson from this period of volatility, this chart offers some perspective about disciplined investors. So what should they keep in mind here?
It definitely does, Paul. This particular chart shows kind of the market bottom during the financial crisis. I remember that time well, where the Dow kind of bottomed out near 6,500, and it felt like the sky was falling at that point in time. But we look at those who persisted in investing over that period of time, and if you had 6,500 in it at that point in time, it would be worth 48,000-ish today, by virtue of sticking with it. And U.S. capital markets are resilient. They drive wealth accumulation over time. And I don't think any of that dynamic has changed. So I think this is good to sometimes to zoom out, look at the big picture during times of kind of stress, and know that this is the bigger picture and have that long-term perspective.
Awesome. Great insight, Scott. We appreciate all the professional angles you bring to our clients. And the perspective that we get to enjoy here. So to all of our clients join us on the call today, thank you. Reach out if you've got more questions, more concerns that you want to address here with the team. We are here and ready to help answer questions and things that are specific to your portfolio. Communication is always great. So the more you guys are feeling those moments of anxiety or panic, just reach out. It's a phone call away, and we're here to kind of walk you through kind of how your portfolio is moving and acting, and what we need to do to help you kind of get that kind of foundational piece that you need in retirement. That is why we are here. So until next time, everybody, we sure appreciate you all. Enjoy it. Thanks, guys.
Thanks.